Welcome back to the Deep Dive. We're on the final leg of our journey into the world of intercorporate investments.
And it's been quite a journey, hasn't it?
It has. From the basics to some really complex topics, but it's been fascinating.
Absolutely.
In this final part, we're focusing on those comparability issues that come up when you're analyzing companies that use different accounting standards, mainly IFRS and US GAAP.
Right. We've touched on some of these differences,
Yeah.
but let's really dive into the details and see how they can affect our analysis.
Sounds good. Let's start with contingent assets and liabilities.
All right. Contingent assets and liabilities.
Yeah, these can be tricky because they involve future events that might not even happen.
And IFRS and US GAAP have slightly different ways of dealing with them.
Of course they do. Can you give us an example of how these different approaches might work in real life?
Sure. Let's say a company buys another company that's involved in a lawsuit.
Okay.
The outcome of the lawsuit is uncertain, but there's a chance the acquired company might have to pay a lot of money.
Right. It's a potential liability.
Exactly. Now, under IFRS, the acquirer would only recognize this contingent liability if they could reliably measure its fair value.
So if it's really uncertain how much they might have to pay,
Right.
they might not recognize it at all.
Exactly.
Okay, so IFRS is being cautious, only recognizing the liability if we can put a fairly accurate number on it.
That's a good way to put it.
What about US GAAP?
US GAAP makes a distinction between contractual and non-contractual contingent assets and liabilities.
Okay, so contractual contingencies are things like those that come from a formal agreement,
Right.
and they're usually recognized at fair value.
Exactly. Non-contractual ones, like our lawsuit example, are only recognized if it's more likely than not that they'll meet the definition of an asset or liability at the time of the acquisition.
So it seems like US GAAP is a bit more willing to recognize these non-contractual contingencies, even if there's still some uncertainty.
That's
It's
right.
like they're trying to capture the potential impact of these events, even if they haven't fully played out yet.
That's a good way to think about it. And this highlights the importance of understanding those differences in recognition thresholds when comparing companies that use different standards.
Right, because a liability that's recognized under US GAAP might not be recognized under IFRS.
Exactly.
And that could change our view of the company's risk.
Absolutely. Now let's talk about measurement.
Okay, so once we've decided to recognize a contingent asset or liability, how do IFRS and US GAAP measure it?
Well, that's another area where they diverge a bit.
Okay, how so?
IFRS usually requires you to measure it at the higher of the amount you initially recognized or the best estimate of what it'll take to settle the obligation. But US GAAP uses a bunch of different methods depending on the type of contingency and the information that's available.
So the measurement rules can be pretty complicated,
They can.
and they change based on the specific situation.
That's right. Analysts need to carefully review the footnotes and understand what assumptions the company's making.
To really understand these contingent items.
Exactly.
Yeah.
It's all about understanding the economic reality of these complex arrangements. Now, let's move on to contingent consideration.
Contingent consideration, okay.
This often comes up in business combinations.
Right, it's like an extra payment that the acquirer might have to make to the acquiree's shareholders
Right.
if certain things happen in the future,
Right.
like hitting performance targets.
Exactly. And both IFRS and US GAAP say you have to measure contingent consideration at fair value when you first recognize it.
Okay, so far so good.
But they differ in how they classify and account for changes in that fair value.
Ah, here come the differences again.
IFRS is more flexible.
Okay.
It lets you classify contingent consideration as an asset, a liability, or even equity.
So it can move around on the balance sheet?
It could, depending on how those future conditions play out. US GAAP is simpler.
Okay.
It's either an asset or a liability, and it stays there.
All right, so under IFRS, things can be a bit more dynamic,
You can.
while US GAAP keeps it more straightforward.
Right. And how you account for changes in fair value also depends on how you classified it. This is where analysts need to really dig into those footnotes.
To figure out what the company is doing.
Exactly. So contingent consideration is another area where comparability issues can arise.
Got it. Now, let's talk about something that's really important for innovative industries. In-process R&D.
Yes, in-process R&D.
This is a big deal for companies in fields like pharmaceuticals and technology,
So,
where new products and services are everything.
and when a company acquires another company that has R&D projects in progress,
Right.
we need to figure out how to account for those projects in the acquisition.
And I bet IFRS and US GAAP have different ideas about that too.
You know it.
So how do they approach in-process R&D?
Well, Both IFRS and US GAAP recognize in-process R&D as a separate, intangible asset.
So it gets its own line item on the balance sheet.
It does, as long as it meets certain criteria.
Okay, what are those criteria?
The R&D project needs to be far enough along that we can reliably measure it.
So we need enough information to estimate its fair value.
Exactly. If the project is still early stage and there's a lot of uncertainty, it might not qualify for separate recognition.
So we need to look at how mature the R&D project is and how much information we have.
Right. And once we've recognized it,
Yeah, what happens then?
it depends on whether the R&D project is successful.
Okay.
If it leads to a marketable product, we amortize the asset over its useful life.
So we're gradually recognizing the economic benefits as they're generated.
Exactly. But if the project fails,
Meaning no marketable product.
right, then we have to recognize an impairment loss.
And reduce the value of the asset.
That's right.
So in-process R&D can be a valuable asset, but it's also risky.
It is. It's high risk, high reward.
Analysts need to understand the industry and the company's track record with R&D to assess these assets properly.
Absolutely. We've talked about contingent assets and liabilities, contingent consideration, and in-process R&D.
We have.
All areas where we can run into comparability issues between IFRS and US GAAP. One more thing to watch out for is restructuring costs.
So restructuring costs.
These are costs that companies incur when they're making big changes to their operations.
Like closing factories, laying off employees, or reorganizing.
Exactly.
And these costs can be huge, especially after a business combination.
They can.
So how do IFRS and US GAAP handle these costs?
Good news. IFRS and US GAAP actually agree on this one.
Oh, that's a nice change of pace.
Restructuring costs related to a business combination are not included in the acquisition cost. They're expensed as they're incurred.
So we're not spreading those costs out over time. They're recognized immediately as expenses.
That's right.
This makes sense because it shows the true cost of the acquisition and the restructuring.
Exactly.
And this agreement between IFRS and US GAAP makes it easier to compare companies from different places.
It does.
Because we know they're using a consistent approach.
That's right.
Wow, we've learned so much in these three parts. From the different types of investments and accounting methods to the complexities of consolidation, intercompany transactions, and those tricky comparability issues.
It's been a deep dive for sure.
It has. But we've given you the knowledge you need to navigate this world of intercorporate investments.
Whether you're studying for the CFA exam or just trying to understand how businesses work, these concepts are essential.
Absolutely. So go out there, ace that exam, impress everyone with your knowledge, and keep learning.
The world of finance is always changing.
It is. Who knows what exciting new accounting standards or investment strategies will come up next? That's what makes it so interesting.
Thanks for joining us on this deep dive.
And until next time, keep exploring, keep learning, and keep asking those tough questions.